Good afternoon. Central Bank of Nigeria Communique number 88 of the Monetary Policy Committee meeting of Monday and Tuesday, March 18th and 19th, 2013. The Monetary Policy Committee met on March 18th and 19th, 2013 with all the 12 members in attendance. The committee reviewed the conditions and challenges that confronted the domestic economy in the first quarter of 2013 against the backdrop of current international economic and financial developments, with a view to reassessing the monetary policy options in the short to medium term. International economic developments. At the outset, the committee observed that global growth remained subdued throughout 2012 due to the softer than expected level of activities in the euro area and the slipping of Japan into recession during the second half of the year. Weak and fragmented growth was also recorded across major economies and regions, including the US. The emerging market economies, however, showed a fair degree of resilience. The growth outlook, however, appears promising. The IMF January 2013 WEO update projected a global output growth of 3.5% in 2013, compared with the 3.2% achieved in 2012. In the advanced economies, output was estimated at 1.4% for 2013, compared with 1.3% achieved in 2012. Recession is expected to continue in the euro area, although the magnitude of the contraction, estimated at 0.2% in 2013, represents an improvement over the 0.4% contraction of 2012. A slowdown in growth is also expected in the US in 2013, as output is projected to decline by 2% from 2.3% in 2012, owing largely to the short-term effects of its fiscal consolidation regime, as well as weaknesses in the labor and housing markets. The emerging Asian economies were projected to post a gradual recovery that would propel global output growth in 2013. China, which previously recorded a slowdown over several consecutive quarters to Q3 2012, witnessed improved activity in Q4 2012, confirming that an upward swing in growth is underway. The recent fiscal and monetary easing operations of the People's Bank of China led to increased tempo of investment in infrastructure, with indications of further public spending in 2013. Thus, the economy is expected to grow strongly amid gradual improvements in the external environment. Japan returned to growth in the fourth quarter of 2012, raising hopes of an end to 15-year deflation. The major setback in the region is expected from India, with real GDP growth of 5.4% in 2012 on account of poor performance of manufacturing, agriculture, and service sectors. The committee noted that growth in sub-Saharan Africa was still robust, although real output dropped to 4.8%. Real output growth dropped to 4.8% in 2012 from 5.3% in 2011. The performance of sub-Saharan Africa during 2013 would partly depend on developments in the euro area, as well as the extent of recovery in China. With policy buffers weaker than they were prior to the 2008 crisis, the ability of governments to implement counter-cyclical fiscal policy may be constrained. Domestic economic and financial developments. Output. The committee was satisfied with the relatively robust output growth projections for 2013, despite the slowing global economy, on the back of favorable conditions for increased agricultural production, the outcome of banking sector reforms, as well as other initiatives by the government to stimulate the real economy. The National Bureau of Statistics reported that real GDP growth rate declined from 7.43% in 2011 to 6.58% in 2012. The decline was partly driven by the oil sector, which contracted by 0.91%. The major driver of overall growth, therefore, remained the non-oil sector, with agriculture, wholesale and retail trade, and services contributing 1.37, 2.19, and 2.10 percentage points respectively. The committee was concerned that the declining contribution of the oil sector to growth, which became apparent in the second half of 2011, continued in Q4 2012. Crude oil production, including condensates and natural gas liquids, decreased by 37,000 barrels per day in February 2013 to 2.054 million barrels per day, compared with the level of 2.074 million barrels per day until December 2012. Oil theft in the Niger Delta remained a source of concern. The committee was also concerned that the decline in the growth rate of agricultural output continued up to the end of 2012. The committee was of the view that although GDP growth projections remained high, there were a number of risk factors that were likely to affect output performance. These include perception of increased levels of corruption, insecurity, particularly in the northern part of the country, as well as mixed signals from the power and petroleum sector reforms. Prices. Headline inflation, which had increased to a 4-year low of 9% in January 2013, inched up to 9.5% in February, driven largely by the food component. Food inflation, which was 10.1% in 2013, increased by 0.87% in February, due mainly to increases in prices of farm produce and imported food items. Core inflation, however, moderated slightly between January and February 2013. The committee noted that the sharp drop in inflation in early 2013 compared with early 2012 is largely a result of the base effect of the partial removal of fuel subsidy in January 2012. With the tapering off of the first and second round effects of the increase, the prudent monetary policy stance and stable exchange rates are yielding lower headline inflation figures. Monetary, credit, and financial market developments. Broad money supply grew by 2.86% in February over the level at end December 2012, which annualizes to 17.16%. Aggregate domestic credit grew by 10.17% over the same period, an annualized rate of 61.02%. The significant growth in net credit in the period was due to the huge increase in credit to government, which rose by 108%. Interest rates in the interbank money market declined between January 21 and March 14, owing to the liquidity surfeit in the banking system. The interbank call and OBB rates, which opened at 10.35 and 10.33% on January 21st, closed at 10.29 and 10.28% respectively on March 15, 2013. The average interbank call and OBB rates for the period were 11.38 and 11.23% respectively. The average prime lending rate inched up slightly from 16.54% in December to 16.56% in February, while the maximum lending rate more or less remained flat at 24.6% per annum during the period. The weighted average deposit rate, however, increased from 3.77 to 5.37% during the period. The committee noted the upswing in the activities of the capital market as equities market indicators all trended upwards in the review period. The all-share index increased by 17.3%, while market capitalization rose by 17.5%. The committee, however, observed that the improved performance was largely induced by the substantial portfolio inflows as foreign investors took advantage of the favorable domestic environment brought about by the high yields on government securities and stability of the naira exchange rate. External sector developments. At the wholesale Dutch auction system, interbank and BDC segments of the foreign exchange market, the exchange rate opened at 157.29 naira to the dollar, 157.1 naira to the dollar, and 159 naira to the dollar on 22nd January 2013, and closed at 157.32, 158.65, and 160 naira on March 15, 2013. The average WGAS interbank and BDC exchange rate during the period was 157.3 naira to the dollar, 157.65 naira to the dollar, and 158.94 naira to the dollar respectively. The committee noted the slight depreciation in the exchange rate at the WGAS and interbank segments of the foreign exchange market. The BDC segment, however, appreciated during the period. The committee expressed satisfaction with the significant accretion to external reserves, which stood at $49.38 billion as at March 14, 2013, representing an increase of $5.5 billion or 12.68% over the level of $43.83 billion at the end of December 2012. The increase in reserves was driven largely by the proceeds from crude oil and gas sales and crude oil-related taxes, as well as reduced funding of the WGAS. The reserve level could finance over 13 months of imports. The committee urged the bank to continue the monitoring of portfolio and foreign direct investment flows while being conscious of the risks to financial stability of a rapid outflow of hot money in the event of a shock. The committee's considerations. The committee was satisfied with the prevailing macroeconomic stability despite shocks from both external and domestic environments, a development which informed the tightening stance of monetary policy since the third quarter of 2010. Having achieved a reasonable degree of moderation in the rate of inflation, there were compelling arguments to consider easing monetary policy, at least from the perspective of stimulating growth in the real sector. Given the slowdown in overall GDP and a cultural GDP growth, inability of SMEs to borrow at the current lending rates, and crowding out effects that may require monetary easing. The committee carefully weighed the option of relaxing monetary policy against the likely risk in the near to medium term, noting that reversing the current stance of monetary policy was not likely to produce a neutral outcome, as it may signal the preference for a higher inflation rate on the part of the central bank. At 9.0% and 9.5% in January and February respectively, the price data, which largely reflected the base effects of the first and second round impact of fuel subsidy removal in 2012, sent a clear signal that there was still an upside risk to inflation in the near to medium term. Furthermore, yields on exchange bonds have been declining steadily, signaling the impact of increased inflows, while equity prices have been trending upwards. Quantitative easing, especially in the US and the EU, is already creating a potential new round of asset bubbles globally. The committee was of the view that the growth in the domestic capital market was driven largely by the huge capital flows. The principal risk to stability in the medium to long term can be addressed through diligent implementation of sound policies of fiscal consolidation and structural reforms. Without these, the economy will not be able to attract long-term foreign capital inflow that makes the gain of monetary policy sustainable and insulate the economy from the risks associated with external shocks and capital flow reversals. Monetary policy will therefore seek to preserve the current gains of macroeconomic stability in the short term, while fiscal and structural policy kick in. The committee also noted the wide spread between deposit and lending rates, which attributed to the inefficiencies in the market, requiring institutional and structural reforms that would enforce behavioral change in the market consistent with long-term needs of the economy. The committee was of the view that the sustainable low interest rates could be achieved if the necessary infrastructure, such as stable power and good roads, amongst others, were put in place. The committee noted that the present infrastructural condition has always provided an incentive for asymmetric response on the part of banks to the policy rate in a manner that was not always beneficial to the small and medium-scale customers. With respect to the price level, the committee observed that the rising pressure in February after significant moderation in January was indicative of the fact that there were some underlying factors that would constitute a threat to inflation in the medium term. The committee noted the 2013 federal government budget of $4.9 trillion passed by the National Assembly and signed into law by the President. And this represents an increase of about 5%. Furthermore, the budget predicated on an oil benchmark price of $79 per barrel, as against the $75 per barrel proposed by the executive, potentially slows down the pace of fiscal consolidation with implications for accretion to the excess crude account and processing reserves. In addition, the committee observed that the foreign exchange market has started experiencing pressure in March 2013, mainly reflecting compression of yields in the fixed income market, as well as outflows to pay dividends by multinational corporations. However, the committee noted that the exchange rate has remained within the target range, and also that the current monetary conditions are conducive to further tightening using open market operations without recourse to an increase in the MPR. In view of all these developments, the committee was faced with three options. The first was an increase in rates, in response to the uptick in headline and food inflation and pressure on exchange rates. Second, a reduction in rates in view of declining core inflation and GDP growth. Third, retaining current monetary policy stance to sustain the gains of monetary policy while utilizing the existing space in the corridor to influence yields and exchange rates in the short term. The committee's decisions. The committee considered and rejected option 1 as being unnecessary since there are no major inflationary concerns at this time, while acknowledging the merit of the arguments in favor of option 2. It was also rejected by the majority because it could send wrong signals of a premature termination of an appropriately tight monetary policy stance. The committee therefore decided by a majority vote of 9-3 to accept option 3 and maintain the current policy stance, i.e. to retain the MPR at 12% with a corridor of plus or minus 200 basis points around the point, retain the cash reserve requirement at 12% and equity ratio at 30% with net own position at 1%. Thank you.
Please, if you would like to ask a question, quickly identify yourself and go straight to the question. Your name and the media house you represent. Please line up behind one of the mics there.
Good afternoon, Governor, Deputy Governors. My name is Idris Samuel from the Literacy newspaper. The government has been fighting corruption and saying that it has done so much to bring it down. But you listed corruption as one of the risk factors that will affect the economy. Are you saying that the level at which the government is fighting corruption is low, or specifically, how would you want the government to fight corruption? Thank you.
I have said nothing of the sort, but I have said that corruption is a problem in the face of long-term investment, and I'll stop there.
Please, let's focus on monetary policy.
No, that's fine. You can ask any question. It's up to you to answer.
Good afternoon. My name is Elisha Olakubo. I report for Bloomberg News. On Friday, the CBN was set to intervene in the market when the Naira came under intense pressure most of last week. Question is, will the CBN continue to intervene outside the twice-weekly auction when the Naira encounters this kind of pressures?
I mean, look, this committee has always said that exchange rate stability is integral to our price stability mandate. And we have said we have a target range of 155 Naira plus or minus 3%. We have the reserves of 49 billion. We have the space. OPP and interbank rates have been hovering around 10%. They can go up to 14 through OMO. So we have the monetary space to do OMO, to sell more dollars, to keep the Naira stable. And so if we see the Naira pushing any of the limits, we'll step into keep it there. And we have the ammunition to do so.
I guess that's all. I guess that's all, sir.
Thank you. 0.66%. The appreciation recorded in all segments of the market could be traced to the combined effects of tight monetary conditions, improved supply of foreign exchange to the market by all companies, increased inflows from portfolio investors, and the policy that barred the DMBs from accessing the CBN lending window and WDAS simultaneously. The committee noted with satisfaction that the premium between the rates at WDAS and Interbank and between WDAS and BDCs narrowed towards the end of the review period from 0.74 Naira to the dollar and 3.64 Naira to the dollar to 0.03 Naira to the dollar and 1.68 Naira to the dollar respectively, suggesting the need to sustain and further complement existing measures to discourage speculative activities in the foreign exchange market. In general, The committee noted that the decisions taken at previous MPC meetings are yielding the desired results. The committee expressed satisfaction with the significant accretion to external reserves, which stood at $45.68 billion as at November 15, 2012, representing an increase of $10.27 billion, or about 29%, from the level of $35.41 billion as at end June 2012. Compared to the year end of 2011, external reserves had increased by $13.04 billion, or 39.95%, over the level of $32.64 billion. The increase in the foreign reserves level was driven mainly by proceeds from crude oil and gas sales and crude oil-related taxes, as well as reduced funding of WDAS due to increased inflow of foreign direct investment. The foreign reserves level will finance over 10 months of imports. The committee urged the central bank to continue to monitor the inflow and destination of FDIs and remittances, conscious of the risk to financial stability of a rapid outflow of hot money. The committee's considerations. The committee noted that developments in the global economy characterized by general uncertainty on the back of the deceleration in global growth sustained by the fragile financial conditions, weakening labor and housing markets, and deteriorating public and private balance sheets across advanced and emerging economies have implications for the domestic economy, and therefore demand careful consideration in arriving at an appropriate decision of monetary policy. The uncertainty surrounding the resolution of the fiscal cliff in the US and the downside risk created by Hurricane Sandy on US output in Q4 are also important factors to consider. The committee noted that if the fiscal cliff was not resolved quickly, it would negatively impact the already ballooning deficits and subsequently tip the economy into a recession with downside risk to all price developments. The committee noted that the lack of clear direction for the resolution of the euro area crisis will continue to signal a likely recession in the area in the near term. Developments in the domestic economy in the past 3 months highlight some new pressure points to macroeconomic stability. The committee was of the view that despite high interest rates, additional shocks to the economy emanating from devastating floods, imported inflation, and the upward adjustment of electricity tariffs continue to stoke inflationary pressure. The committee noted the conflicting price signals coming from the latest inflation numbers from the National Bureau of Statistics, with headline and inflation trending upwards, while core inflation rates continue to moderate for the 4th consecutive month. This, according to the committee, has created uncertainty as to the appropriate policy stance at this time. However, since the factors underpinning the inflationary pressures were mainly structural, a monetary response may not be appropriate. Furthermore, the committee observed that while there were compelling arguments for monetary easing at this time, based on the continuous moderation of core inflation, slowdown in GDP growth, and evidence of fiscal prudence, the short-term gains may not be sufficiently adequate to overturn the long-term implications of sending a wrong signal that the tightening cycle was permanently over. With regard to the balance sheet of the federal government, the committee was of the view that it has become imperative to shift away from looking at the size of the deficit and borrowing alone to emphasizing the quality of expenditure and decisions on the allocation of resources. The committee commended the fiscal authorities for keeping the fiscal deficit firmly in line with the 2012 budget and improving the revenue profile of the federal government by plugging several of the fiscal leakages. It called on the government to significantly increase capital spending and increase its focus on improving on governance and transparency in the public service. On the oil price benchmark used in the 2013 budget, the MPC reaffirmed its support for maintaining the $75 a barrel proposed by the fiscal authorities and noted that this has become even more critical in light of evidence that output projections may have been overly optimistic. In this regard, the committee calls on the government and the National Assembly going forward to borrow from the Chilean experience with regard to setting up parameters for the preparation of the national budget to avoid the perennial rancor between the executive and the legislature on benchmark oil price. Specifically, the committee called for the setting up of an independent legal structure that will set the benchmark output and price underpinned by a long-term trajectory of output and prices by independent experts who are shielded from political interference and interests. In view of these developments, the committee was faced with three choices. One, an increase in rates in response to the uptick in headline and food inflation. Two, a reduction in rates in view of declining core inflation and GDP growth. Three, retaining current monetary policy stance in view of conflicting price signals and global uncertainties. The committee's decision. The committee considered and rejected option one as being potentially pro-cyclical, considering the structural nature of recent inflationary pressures. While acknowledging the merit of the arguments in favor of option two, it was also rejected as likely to send wrong signals of a premature termination of an appropriately tight monetary stance. The committee therefore decided by a unanimous vote to maintain the current policy stance, i.e. to maintain NPR at 12% plus or minus 200 basis points, maintain the CRR at 12% and the liquidity ratio at 30%. Thank you.
Please, questions, there are microphones. Identify yourself and the media house you represent. Keep it short, please.
CBN Africa. How concerned is the MPC about the global economic slowdown next year, given the threat of US rolling over the fiscal debt? Thank you.
Madam Mayor from Bloomberg News. I just wanted to ask about the inflation outlook for next year, if possible, and if you have an estimate for this year, the average inflation rate. And for the Naira, are we going to see any more changes in next year? Another denomination?
Please go on. Are there any other questions? Okay, I'll just answer.
Well, my question is basically from what was read. How do you suggest, you recommended the Chilean economic modus operandi. How can we localize that Chilean approach, at least to factor Nigerian local context? Thank you very much.
All right, okay, basically, we spent a lot of time in the community talking about the global concerns, and these concerns feature very heavily in the consideration and discussions today. A lot of the argument was we cannot take decisions without looking at what is happening outside. The slowdown in the US is just one part of the problem. Europe is in recession. The rest of the emerging markets are slowing down. The only thing keeping oil price up is the uncertainty and instability in the Middle East. And if it goes down, we might find ourselves in a situation where we basically moving from one end to another as far as monetary policy is concerned. So in view of all those uncertainties, we've done well so far. We believe we should continue to hold our position until we have clarity on what is happening outside there. On the question of outlook for next year, our own estimate is that we probably might have an uptick of inflation in December. We do think the headline numbers and food numbers will probably be somewhat lower, actually heading towards 10% and the single-digit range early in the year. A significant part of that would be the base effect. Remember that in early January this year there was an increase in oil prices and therefore sharp uptick of inflation. So unless you have a similar shock in December, the base effect is likely to lead to a moderation in those headline numbers. But that does not mean you have a moderation in the underlying inflationary pressures, because if you look at the food index for October, what was interesting was that food prices were not driven by one or two commodities. It was an across-the-board increase. There was one that was flat and one that basically reduced by 0.1%, which isn't much. But every other item of farm produce showed an uptick in inflation. So when you've got such broad-based pressures, you tend to be a bit cautious in forecasts of a deceleration that's very quick. So for the Naira, our stance remains the same. We have always considered a stable exchange rate critical to the anchoring of price expectations. We're under no pressure to change. We're not looking for a strong appreciation. We're also not looking for a strong depreciation. We're an open economy. Unfortunately, we're too import dependent. Therefore, a weak currency does not promote our exports, given the fact that we are an oil-producing country whose commodity is denominated in dollars anyway, whose price is determined by the international markets. So we do not get much mileage by weakening our currency. In the same vein, there is no benefit in running down reserves to have a very strong currency. You make imports cheap, you increase the import-dependent nature of the economy, and you reduce your ability to cope with external shocks. So the key is to have stability. The key is to build up reserves, but far more important for the government to make progress on the structural reforms in the power sector, in the agricultural sector, which will then reduce the dependence of the economy on oil and the vulnerability to commodity price shocks. On Chile, we borrowed many countries that have a commodity price based budget rule have borrowed this from the Chilean example, where based on the price of copper, the budget is made, and this is fine. But Chile has an institution, it has a committee of experts that determines the price of copper, the long-term price of copper, the long-term trajectory of GDP. And those prices are determined independently of the political process. So these experts would, based on total settlement, which I will go to them, say this is the benchmark price for oil, this is the benchmark price, the benchmark output, if that is what the budget is based on. And that should be binding to both fiscal authorities and the National Assembly. This idea that after going through a technical, detailed process, the Ministry of Finance comes out with a number, and then the National Assembly sits down and says, I don't like this number, and I want to increase it, is only possible because we have not institutionalized this process. So it would be very good to not just say you'll use a benchmark, but have a legal framework for determining that benchmark and clarity, so that the decision is not political. Increasing the benchmark to 78 or 80 or 82, we have always said, simply increases the amount of money that is saved, that is spent, reduces the amount of money that we save. And if for any reason output underperforms, and we're already seeing that with the floods already, we're told that MPC has lost production. If output underperforms, you continue dipping into savings, and therefore reducing your fiscal flexibility and your ability to respond in the event of an external shock. Okay, so thank you very much. Can we have more debates?
Problem less